A freelancer making $80,000 just saved more money than an S-corporate owner making $300,000. A solo consultant is celebrating while a law firm partner is scrambling. The new tax law just created a massive winners and losers, and most business owners have no idea which category they are in. I just analyzed over 100 real client situations since the recent legislation became a law, and the results are shocking. Some are saving $25,000 and more annually. Others are actually paying more in taxes. The new tax code literally created different outcomes for different business structures, and your entity type determines everything. I'm Ella Rivkin. I have been helping business owners navigate changes for over 26 years, and I have never seen targeting this specific. In the next 30 minutes, I will show you exactly which of the 7 business types you are in, whether you are celebrating or you need to take immediate actions, and the specific steps for your situation. Here's what's crazy. A simple LLC structure could save you $15,000 this year. A wrong move could cost you twice that. And most accountants haven't even figured this out yet. By the end of this video, you will know exactly where you stand in this new tax law landscape. I'm breaking down the 7 most business owners types, from sole entrepreneurs to multi-million-dollar companies, and showing you precisely what each one wins or loses. You will discover if you are a massive winner who should be accelerating investments, or a potential loser who needs to restructure immediately, or somewhere in between where smart moves can flip into the winner's column. I will give you my action metrics, specific steps for each business type, not just generic advice, plus my updated calculator that factors in the permanent changes from the 2025 tax legislation. All right, so let's start. The 7 categories breakdown. The category 1, solo LLC. The mega winners. If you're a single member LLC, congratulations, you just hit the jackpot. Starting in 2026, the 20% QBI, qualified business income deduction, is now permanent. So let's look at some real numbers. Let's say if you're the business owner earning $100,000 in profit, you will get a $20,000 deduction, resulting in tax savings between $4,400 to $7,400 annually, depending on your tax bracket. And that's every single year. But here is the kicker most people miss. 100% bonus depreciation is back permanently. That means that if you purchase a laptop, camera, office furniture, or even a large equipment, it can all be fully deductible this year. So here's an example. A truck driver who buys a new truck for $90,000 a year can write off the full amount of the cost of this truck, potentially saving between $19,800 to $33,300 in taxes that same year. So here's the action steps for the solo LLCs. Number 1, separate your finances. Open a dedicated business account. This is no longer an option. Number 2, make purchases before the end of the year. New equipment or tools, buy them before December 31st to qualify for the full deduction. And number 3, track everything. Every dollar spent on your business, from internet bills to gas mileage to software subscriptions, every expense, it all matters and should be documented and categorized. So here's another bonus strategy that I would like to share with you. I just gave you an example about the truck driver, but here's if you would like to scale your business, here's what you can do using the same strategy. If you're looking to scale your business, here's a smart move you can start implementing right away. You take the $19,800 you just saved in taxes by using the bonus depreciation, and you use this money as a down payment to finance another truck or a piece of income producing equipment. You will not only deduct another $90,000 and potentially save another $19,800 to $33,300, but also increase your revenue at the same time. This is how small businesses grow into the big ones with strategies, not just an effort. In the next upcoming segment, I will walk you through how solo entrepreneurs can take their tax deductions even further, including advancing write-offs, smart income shifting strategies, and how to legally keep more of what you earn. You definitely do not want to miss this, so stay tuned. Category number 2, Freelancers and consultants, the surprise champions. Freelancers, this might surprise you, but you're among the biggest winners in the new tax landscape. You get the same 20% the QBI deduction as large businesses, but with more flexibility and less red tape. Let me give you an example. Let's say you are a freelancer earning $60,000 in profit. Thanks to the QBI deduction, you can deduct $12,000 out of that, resulting in $2,500 to $4,000 in annual tax savings, depending on your tax bracket. And this is just the beginning. Your home office, internet, phone, computer, software subscription, marketing costs, all of these are fully deductible if you structure your business correctly. The most overlooked factor is your business structure. This is where many freelancers leave money on the table. So here's the quick win strategy for you. If you are still filing as a sole proprietor on a Schedule C, you are overpaying in taxes, period. While many advisors casually recommend becoming an LLC, I will tell you the truth. That's not always enough. In fact, I'm not a big fan of the LLC by the default. Depending on your income and your goals, an S Corp might save you thousands in self-employment taxes. Here's an example. A freelancer earning $60,000 a year. With the self-employment tax, which is 15.3% on the full $60,000, that's $9,180 in self-employment taxes alone that can be saved. And if you're planning to scale or reinvest heavily, a C corporation might be the better long-term play for you. So as you see, it all depends on your strategy, and that's where we come into the place. Here's the action steps for the freelancers. Number 1. Get your structures review. I would suggest to do this before the end of the year. Schedule a strategy session to see if you will be staying as a sole proprietor or if you will be switching to an S corporate or maybe even a C corporation. This might be the best fit for you. Number 2, track and document your deductions. Use a proper accounting software. Keep your books clean and audit ready, because if IRS comes knocking, you want to be bulletproof. And number 3, think like a business owner, not just as a service provider. Build infrastructure now. That includes admin support, invoicing system, and a clear financial strategy. Okay, coming up, stay tuned and I will share how the freelancers can maximize the deductions with the smart business habits, protect themselves from the audits, and scale sustainably while keeping more of what they earn. Moving on to the category 3, the S Corp owners, the complicated winners. So if you're an S Corp owner, you are still a winner under the new law, but with a few more hoops to jump through. You do qualify for the 20% QBI deduction, just like other entities, but only if your payroll is structured correctly and you are paying yourself a reasonable salary. Let me give you a real example. So let's say you are an S corporate which earns $200,000 in net profit, and you pay yourself a reasonable salary of, let's say, $60,000, and the remaining $140,000 is taken as a shareholder distribution. So here's how it will be broken down. You avoid self-employment tax, which is 15.3% on the $140,000. So that will give you a tax saving of $21,420. Now, you still qualify for the 20% QBI deduction, which means 20% of the $140,000, so that comes out to $28,000 deduction. So depending on your tax bracket, that would give you another $6,000 to $10,000 in annual tax savings. So total tax benefit up to $30,000 or more just from restructuring alone. But here is the catch. If you pay yourself too little or nothing at all, the IRS could reclassify distribution as wages, hit you with the back payroll taxes, penalties, and interest, and might even disallow your QBI deduction altogether. So S corporation, it's a tool, not a loophole. Use it wisely. So here's some critical S Corp moves that I would suggest for you to take advantage of right away. Number 1, review your payroll immediately. Pay yourself a reasonable salary based on your role, based on the industry and contribution. And do not guess, document your reasoning. Number 2, keep clean records. Use a proper payroll systems, not just transfer from the business to personal account. Issue a W-2. Track every reimbursement and deduction properly. And number 3, maximize equipment deductions. Use 100% bonus depreciation to your advantage. So here's an example that I would like to share. So let's say you run a consulting firm and this year you decided to upgrade your office setup. So you purchased a desk and a monitor that costed $3,000. And then you purchased a camera, a mic, and lighting setup. So that costed another $5,000. And now you purchased a new SUV for $40,000 and you're using it for the business. So altogether, you spent $48,000. So the $48,000 are fully deductible this year. This can reduce your taxable income from $200,000 to $152,000, bringing even more savings and strengthening your QBI deduction. So now, let's take it even further. Let's now say that you taking advantage of the pension contribution strategy. With a $60,000 salary, here's how you can actually supercharge retirement savings while cutting your taxes. So you can take advantage of the 401k employee deferral, which is up to $23,500 this year if you are under 50 years old, or if you are over 50 years old, then you can make a deduction of $31,000. Or this is with the new law, we have this bonus special catch-up contribution for those that are between the age of 60 to 63. They can make a contribution of an additional $11,250. Also, at the same time, you might be able to take advantage of the employer SEP or a profit sharing contribution, which allows you to put away up to 25% of your salary. In this case, it would be $15,000 of that $60,000 W-2 salary that you're taking. So now the total retirement contribution might be between $38,500 to as high as $49,750. Now, if we convert this deduction into the actual tax savings, that will be between $9,000 to $18,000 in total tax savings a year. So as you see, lower your taxable income even more and build wealth tax-free for the future. So here's another bonus strategy that I would like to share with you. An accountable plan strategy. So what is an accountable plan? Accountable plan lets you reimburse yourself for the business expenses absolutely tax-free without triggering any income. So here's how it works. Let me give you an example. You work from home and you have home office expenses like internet, utility, and then all the other expenses. So if you combine and calculate all of this, it turns out to be $800 a month. So now under the accountable plan, we take this $800 a month times 12, that comes out to $9,600 a year, absolutely tax-free. This $9,600 becomes a deductible for your business, but not taxable to you personally. And you actually can think of this as a bonus money the IRS doesn't even tax. So here's the final thought about the S-Corps. The S-Corps are very powerful, but only if managed properly. So if it's done right, they offer one of the best combinations of tax savings, retirement buildings, and liability protection available to small business owners. The category number 4, partnership, the strategic players. So when it comes to the partnership, your success under the new tax law hinges entirely on how well you plan and structure your entity. Multi-members LLC are taxed as partnership can absolutely benefit from the QBI deduction, but the key is in how income is allocated, how depreciation is used, and how proactive your planning is. So unlike sole proprietorship or S-corporate ownership, partnership offer more flexibility, but also more room for the error. Your gains will depend on whether your partnership agreement, allocation methods, and investment strategies are optimized for your tax efficiency. So here are some strategic opportunities for the partnership. Number 1, the cost segregation on the real estate. Absolutely love this one and use this all the time for myself and my clients. Accelerated depreciation through cost segregation allows you to front load deductions and free up cash flow, especially powerful in the partnership with the real estate assets. Number 2, equipment and technology purchase. The 100% bonus depreciation, it's back. When timing properly, these purchases can dramatically reduce your taxable income, especially if used before December 31st. And number 3, defined benefit and retirement plans. The partnership can supercharge retirement savings with pension plans, especially for the high-income partners nearing retirement. And lastly, number 4, optimize profit allocation. Your K1 income doesn't have to be split 50-50 like it's in a S corporation. Strategically, allocation based on time, capital, or performance can lower for the collective tax burden and maximize available deduction. Let me give you an example so you can actually see how it works. So a real estate partnership, they're using this cost segregation power play. So the scenario is there's 3 partners and they purchase a commercial property which costs $2.4 million. And they're utilizing the cost segregation study, the accelerated depreciation. By doing the cost segregation study for the year 1, they're taking advantage of the bonus depreciation that allows them to deduct $920,000 in one single year from the $2.4 million of that purchase of the commercial property. So now, because there's 3 partners, we're splitting this $920 among 3 partners. So that loss can potentially create a tax savings between $61,000 to $102,000 per partner, depending on the bracket. So here's the key takeaway. Strategic depreciation through cost segregation turns paper losses into real tax savings. Here's another example that I would like to share with you. The medical professionals are among our favorite clients because we understand the unique financial and operational challenges they face. So here's an example. The medical partnership, they purchase the equipment and at the same time they're using the pension strategy. So there's 2 doctors, they earn $850,000 in total in profits in a single year. So now here's the strategy that we're using. They're purchasing the equipment that cost $160,000. Because of the bonus depreciation that we're utilizing in this strategy, we're deducting the whole $160,000. And at the same time, they're utilizing the retirement strategy contribution. So they're contributing $180,000 into a defined benefit plan. So the total deduction is $340,000. So that means that it reduces the taxable income per partner of $170,000. So what it means, it reduces the taxable income per partner in amount of $170,000. And this gives them a total tax savings between $40,000 to $63,000 per each partner. The key takeaway, combine these 2 strategies and then you slash your taxes dramatically while building wealth. So here's the bonus strategy that I would like to share, using a passive losses from one deal to offset income from another. Here's a powerful but underutilized strategy. Allocate more of the K1 profits to the partner in lower tax bracket to reduce the partnership total collective tax liability. So now let's say your partnership owns multiple businesses or properties. One venture generates significant income while another has a paper losses due to depreciation or cost segregation. With proper planning, you can allocate that losses strategically to reduce taxable income on the profitable side. So let me just share with you an example. So let's say it's a partnership and they have one deal, a newly purchased apartment building. With doing the cost segregation, they were able to create a deduction of $200,000 for the cost segregation. So now, if we take this $200,000 and divide among the partners, which are 50-50, giving them the standard allocation, then this will give each partner $100,000 in income from the deal. But what if one partner, let's say partner A, his income is much higher this year due to other deals, while the other partner, partner B, has a lower income. So here's the strategic move. Allocate more of this $200,000 loss to the partner A that has legally higher income based on their level of involvement or capital contribution. Let me just show you in numbers what it would look like. So the partner A, he has already $200,000 in income from other deals. Now, instead of splitting the loss 50-50, we're giving him this $150,000 in loss. So that creates $50,000 in income. And then partner B, his income from other sources is only $100,000. So we're allocating $50,000 loss to him. So that gives him $50,000 taxable income. So the outcome, both partners pay tax only on $50,000 at a lower marginal rate versus if they would have paid at much higher rate for the partner A. So the overall partnership tax burden is now reduced and potentially can save them between $15,000 to $25,000 just by using this allocation strategy. So why it works? The IRS allows flexible profit loss allocation as long as it's detailed in the partnership agreement and has a substantial economic effect. So here are the action steps for the partnership. Number 1, review your partnership agreement. If it hasn't been updated in years, then it may be costing you thousands of dollars. Number 2, plan purchases before December 31st. If you're thinking that you will need next year to buy an equipment, software, or technology, then purchase it this year. So this way you can deduct and take full deductions this current year. And lastly, number 3, talk to a tax strategist, especially if you're planning to sell real estate or buy property or bring new partners on board. Partnership can be one of the most powerful structures for the growth and tax planning if you take advantage of the flexibility and plan proactively. Category number 5. High-income service professionals, the restricted category. If you're a doctor, a lawyer, accountant, consultant, or other high-earning service professionals and your income exceeds $394,600 for married filing jointly or $197,300 for single individuals, the QBI, qualified business income deduction, starts to phase out and disappear completely. But do not panic. While the deduction may be restricted, this is where strategic tax planning becomes your greatest asset. So here's the problem. The service businesses over the income threshold, they lose access to the 20% QBI deduction, which could mean tens of thousands of dollars in lost tax savings each year. But here's the opportunity. Smart restructuring and advanced planning can still unlock all these savings. So here's some strategies that I would like to share with you. The first strategy is the business restructuring. Create a management company. Split your operations into 2 different entities. So here's an example. Let's say entity A, it provides the personal services like medical or legal, and then entity B, it handles administrative or management services. Now, what it's going to look like? This allows you to allocate income more favorably, keeping some income under the QBI limits and optimizing the deductions. So here's an example. Let's say Dr. Sarah, she runs a medical practice earning $600,000 a year. Her advisory team restructures the practice. And now the way it looks, the $400,000 stays in the main profession entity and it's not eligible for the QBI deduction. The $200,000 is shifted to a management company owned by her family trust. Now the $200,000 may qualify for the QBI deduction and she gains $40,000 in tax deductions, saving between $12,000 to $15,000 in taxes. Here's another strategy I would like to share with you. Maximizing the retirement contribution. And the best part of it, you don't need to use one strategy or the other strategy. You can actually combine them all together. So the high-income professionals can defer income and reduce taxable income by creating advanced retirement plans like defined benefit plan, cash balance pension plans, 401k with profit sharing. Let me give you an example. Let's say a law firm partner earns $500,000 and they decide to implement the cash balance plan and contributed $150,000 annually to the plan. What it does, it drops their taxable income and allows them now to qualify for the QBI. So now the 500,000 in income minus the 150,000 in annual tax savings, now their taxable income becomes $350,000, and now they can actually take advantage of the 20% QBI deduction. That will help them to create tax savings between $30,000 to $50,000 in taxes per year, and will help them to build long-term wealth. Here's the third strategy that I would like to share with you: lease equipment and real estate strategically. Instead of owning office equipment or a building in your name or under the main entity, lease it to yourself through a separate LLC. This creates a passive income that may qualify for the QBI deduction while shifting deductible expenses and reducing your main entity's taxable profit. Let me give you an example how it will work in a real-life case. A consultant creates a separate LLC that owns the building and leases to the S corporation that pays a fair market rent. The benefits: first, the rental income may qualify for the QBI deduction. Second, operating business lowers your taxable income. And third, total tax savings might be between $8,000 to $18,000 annually, depending on your lease structure. And lastly, the fourth bonus strategy that I would like to share with you is hiring family members and accountable plan. So here's what you can do. Pay your children up to $15,750 a year, and you will have zero income tax if structured correctly. Second, use an accountable plan to deduct home office, cell phone, internet, travel, and other business-related expenses. And third one, combined with depreciation and pension, and now you are stacking deductions. And as I mentioned before, all the strategies that I shared with you, you don't have to just use one. You can use all of them together. And this is typically what we do when we're working with our clients. Here's an example. A consultant pays her teenager daughter $15,750 for the part-time admin help and deducts it all and uses those funds to contribute to the Roth IRA for her child. This allows her to build generational wealth while saving $4,000 in taxes. And at the same time, since she started this Roth IRA and made the contribution, so any earnings, any profits that I earned throughout all these years in the Roth IRA will be completely tax-free money. Here's the action steps for the high-income professionals. Number one, review your entity structure. You might need to restructure into multiple entities. Might be C corporation or S corporation combo. Number two, design a pension plan. Work with a firm like ours to build a defined benefit or a cash balance plan. Number three, analyze your income streams. Some of this income be reclassified as a QBI eligible. Number four, maximize depreciation and expenses shifting lease, equipment, or real estate. And lastly, number five, do not wait until the end of the year. These strategies must be implemented earlier in order to take advantage of them. The key takeaway: you don't have to lose the QBI deduction just because you are successful. With the right strategies, you can turn restructures into opportunities, saving 5 to 6 figures annually while building long-term wealth. The category number 6, the sole proprietors, the biggest losers. If you are still operating as a sole proprietor, it's time for a serious wake-up call. Yes, you may still qualify for the sum of the QBI deduction if your income is below the threshold limits, but you are missing out on some of the most powerful tax and wealth building strategies available to business owners. And here's the worst part. You are also putting yourself at the high risk of audit and paying thousands more in self-employment taxes than you need to. So let's talk about some numbers. Let's say $60,000 in income as a sole proprietor. Then in this case, you will pay 15.3% self-employment tax on the full amount. And that's $9,180. Now let's add federal tax to that, plus state tax to that, and maybe even some city taxes depending where you live. Then it's gonna equal to the tax burden that can exceed $20,000 to $25,000 annually. Now let's let's compare this to an S corporate structure. Take the same $60,000 and break it down. Take $30,000 as a reasonable salary and the other $30,000 as a distribution not subject to self-employment tax. That will generate immediately $4,590 in savings right there just from restructuring. So here's some red flags that I want to talk about: the IRS and Schedule C audits. Here's something most freelancers do not realize. IRS data consistently shows sole proprietors audit 2 to 3 times more often than S corporation or partnership. Filing as a sole proprietor on a Schedule C is one of the biggest red flags for the IRS audits. Now you might be wondering why. Well, first of all, they do not have proper books. They mix personal and business funds. They over-report deductions without documentation. There is no payroll structure, high deductions with the low income, home office claims, or cash-based service businesses. The result, even if you're trying to do the right thing, you're an easily audit target. By upgrading your structure and implementing clean systems, you not only save in taxes, you also reduce your audit risk. So here's the strategic fix: restructure immediately. And it's easier when you think. Number 1, file LLC paperwork. It takes less than a day in most states. Number 2, get an EIN number, and it's absolutely free. You just apply it and get it from the IRS. Number 3, elect S corporate status if you have time to do this before March 15 for the current year. Number 4, set up a payroll system. Number 5, create a separate bank account. Number 6, track all business income and expenses properly. Here's the final thought: every month you wait is a money loss to taxes. The difference between a sole proprietor and an optimizing S corporation could be $5,000 to $15,000 in annual savings or more as your income grows. Do not wait until tax season to act. Restructuring now sets you up for the savings that last a lifetime. Now, lastly, the category 7, the C corporations, the long-term players. C corps have long been misunderstood, but under the new tax law, they are making a serious comeback, especially for the business owners thinking long-term. While they're not right for everyone, C Corp offers massive potential for wealth building, reinvestment, and legacy planning if structured and used correctly. So what makes C Corporation unique? Number 1, the flat federal tax rate of 21%, no matter how high the income grows. Number 2, ability to retain earnings within the business. Number 3, you can deduct full benefits for employees and owners like healthcare, life insurance, and others. Also, you can offer great retirement plan flexibility and opportunities. And lastly, provide the best setup for business seeking outside investors or building legacy entity. So now let's talk some numbers. Let's say the C corporation has a profit of $500,000 at the end of the year. So now with the new tax law, the 25% corporate tax rate, they're only paying $105,000 in taxes. It retains the $395,000 to reinvest or redistribute as dividends. So now compare this to an S corporation. The S corporation, it passes all income to the owners. And then once it passes to the owners, the tax rate can reach as high as 37% for the federal, plus the state rate depending on which state are you in. Tax is due whether or not the cash stays in the business or not. But the downside for the C corporation that it faces double taxation. If profits are distributed as dividends, then they taxed again. And the dividends are typically taxed between 15 to as high as 23.8% depending on your tax bracket. The smart move is to keep profits in the company, reinvest strategically, or use fringe benefits and retirement strategies to reduce taxable profits. Here are some examples of strategic use of the C corporation. Deduct 100% of health and life insurance. Here's an example. A wellness clinic pays $30,000 in family health premiums and $10,000 in whole life insurance policy. So now they can deduct all of this at the corporate level. There will be no income reporting for the owner under proper plan structure. Here's another example, another strategy: lease real estate from another entity. Set up a real estate holding LLC company, rent your office space to your C Corp at the fair market value. Now, what's available to do? Deduct rent from the C corporation, receive passive income in the LLC, use depreciation and cost segregation to reduce tax on rental income. And here's another strategy: create advanced retirement vehicles. Like you can use 401k plan, defined benefit plans, cash balance plans. The C corporation can contribute between $66,000 to $265,000 per year for the owner, depending on an age and income. And another strategy: hire family members. Pay your kids or a spouse through the C corporation with W-2. This allows you to deduct salaries as a business expense, shift income to lower tax bracket, contribute to Roth IRA or college fund with tax-free dollars. And here's a real example to share with one of our clients. Meet Dr. Sarah. Dr. Sarah owns a medical practice earning $900,000 in profit. So she formed the C corporation, hired herself and then her husband on a W-2, and then she was able to deduct $60,000 in family healthcare premiums. She also created a defined benefit plan and contributed $200,000 a year to the plan. She purchased a life insurance and wrote it off, and she leased her building to her own company, deducting another $120,000 in rent. So the total tax savings over $300,000 annually, full legal IRS approved strategy. So now, how do you determine is a C corporation right for you? Yes, if you invest most of your profits, you want to offer full benefits and retirement to yourself and your team, you are thinking long-term, exit strategy, legacy, or funding and expansion. Nor if you want to pool profits for the personal use annually, if you're not ready for the compliance and payroll complexity, you are in a low profits or loss generating phase of the business. The final thought about the C corporation. The C corporation are not for everyone, but for the right business model. They unlock opportunities no other structure can. They are the ultimate wealth building engine, then combined with the smart planning, like real estate, defined benefit plans, family employment, and reinvestment strategies. Stay tuned, because next we'll cover how to choose the right entity for your goals and what most accountants completely miss when giving advice. And remember, the right structure could mean a difference of $10,000 to even hundreds of thousands per year in your pockets. So here's the action matrix. Now that you know which category you fall into under the new tax law, let's break down your next best move, because information without action is just wasted opportunity. The category 1, the solo LLC, the mega winners. The action: number 1, make all equipment and asset purchases before December 31st to maximize the 100% bonus depreciation. Number 2, open a dedicated business bank account if you haven't already done so. And number 3, start tracking every expense down to mileage and software subscriptions. The category 2, freelancers and consultants, the surprise champions. Here's the action plan for you. Number 1, if you are still filing as a sole proprietor, explore converting to an S Corp, potentially to save thousands in self-employment taxes. Number 2, get your books in order and start preparing for the retirement contribution and deductions. And number 3, begin thinking like a CEO, not a gig worker. The category 3, S Corp owners, the complicated winners. Here's the action plan for you. Number 1, review your payroll structure immediately. Ensure you are paying a reasonable salary. Number 2, implement an accountable plan to deduct reimbursements completely tax-free. Number 3, make equipment or vehicle purchases by the end of the year to leverage bonus depreciation. And lastly, explore 401k or a SEP contribution to supercharge your savings. Category number 4, partnership, strategic players. Here's an action plan for you. Number 1, revisit your partnership agreement. Make sure income allocation is optimal. Number 2, consider partners' tax brackets, then splitting the K1 income or losses. Number 3, explore cost segregation studies if you own real estate. And lastly, number 4, coordinate deductions like vehicles or equipment based on usage and ownership. Next, the category 5, the income service professionals, the restricted category. Here's an action plan for you. Number 1, segment business activities, separate non-specified service business functions into the own entity then possible. Number 2, max out retirement contributions like 401k, SEP, defined benefit plan. Number 3, explore C Corp restructuring if benefits outweigh pass-through limits. And number 4, leverage equipment leasing, pension plans, and insurance to reduce your AGI. The category 6, the sole proprietors, the biggest losers. Action plan for you. Number 1, file for LLC or S Corp status immediately. Number 2, every week you wait equals to money lost. Number 3, upgrade your mindset, your entity, and start operating like a real business. And lastly, number 4, begin preparing to clean your books and systems for the next tax year. Category number 7, the C Corps, the long-term players. Here's an action plan for you. Number 1, evaluate the C corporate structure if it's right based on your reinvestment plans and benefit needs. Number 2, set up fringe benefits, health, life, retirement, and deduct them. Number 3, consider leasing real estate to your own C corporation. Number 4, use defined benefit or a cash balance plans to shelter 6 figures legally. And lastly, hire your family members and shift income to lower tax brackets. Here's the takeaway. The tax strategy is not about reacting in April. It's about planning right away or before the end of the year. The right moves now will set you up to save 10,000, 15,000, or maybe even hundreds of thousands today in 2025, in 2026 and beyond. Do not guess. Take actions right away. And if you need help implementing this, then let's book a personalized strategy session, because the best tax return is the one that was strategically planned in advance. Here are some critical mistakes to avoid. Number 1, waiting for your tax advisors. Many are still catching up on all these changes. Number 2, mixing business and personal expenses. This weakens your ability to claim valid deductions. Number 3, poor documentation. Proper record keeping is essential for these benefits. Number 4, using wrong business structure. This alone can cost you thousands of dollars annually in missed opportunities. And lastly, number 5, missing timing deadlines. Some benefits have a specific year-end requirements, and you definitely do not want to miss up on that. Here's an important disclaimer. This is educational content about tax law changes. Always consult with qualified tax professional for your specific situation, as individual circumstances vary and tax law are very complex. Here's the reality. This opportunity has specific time and requirements. Equipment purchase, business structure changes, and some benefits have a year-end deadlines. Proper planning can help you maximize all these opportunities. If you are in a category 1, 2, or 7, you are winning big, but only if you act fast. Category 5 and 6 need immediate restructuring. Category 3 and 4 need strategic planning. For complex situations or businesses over 200,000, professional guidance is recommended. There are many opportunities specific to your situation that require expert analysis. The new tax law just gave you the playbook, so now you just need to execute that. Drop a comment which category you are in and your biggest takeaway. Subscribe if this breakdown saved you money, and share it with other business owners who need to see this. And remember, financial freedom is all in your hands.